Howdy, Jacob here. Today we're looking at Costco Wholesale Corporation. We have the legend himself, not Warren Buffett, but Charlie Munger's favorite company, I presume. RIP as well. Founded in 1976. They are pretty much everywhere now. They are They offer a membership service. They have their $1.50 hot dogs. I presume people have heard about them. I don't have to say much more, but their growth is astounding. This is one of those businesses that reminds me of a C's candy without the margins per se, where they can increase in the aspect that they can increase their memberships more than the cost of inflation, and their demand will actually still be going up. And so I think that I haven't dug into the 10Q or 10K, but I presume that's absolutely the case, especially when we see revenue growth well above inflation. And I presume they're not just increasing the number of stores like crazy. So I do think this would be a business where that if they were to increase their membership cost 20%, they might lose 1 to 3% of members. And so this is definitely a big moat business in my perspective. I think you have the BJ's and the Sam's Clubs of the world that try to compete, but I don't think they have anything on Costco. So 379 billion market cap, 373 billion enterprise value. They're quite large. Growth is over double in revenue the last 10 years. So we're looking at 7 to 9% on the revenue growth side per year, very substantial. Gross margin pretty consistent at 12%, operating margin up slightly in the low to mid 3% range. They pay a dividend, but it's really, really low compared to their earnings per share. And the fantastic return on invested capital, nearly 20%, high teens, beautiful. Love to see that. Balance sheet has 13, 14, about 15 billion cash-like products with 1 billion short-term debt, 5 billion long-term debt. Zero concern on this balance sheet. They have more debt, or they have more cash on hand than their interest-bearing debt, inclusive of capital leases. So we're definitely not concerned about that. Cash flow statement shows over double in capital expenditures, but well over double in cash from operations, meaning that they are just cash cows, really getting some big money. They've made one decently sized net acquisition, and outside of that, their dividend of 1.2, 1.4 looks like they do pay one-time dividends, but outside of that, share repurchases and dividends really what the majority of their money's going for. So I think that their 1% or 0.5% dividend yield pays out maybe 15, 20% of their free cash flow. But at times, if they have nothing else to invest in, they do give money back to shareholders through a one-time dividend, which, I mean, I don't find terrible. If you have nothing to invest in, then, I mean, give the money back to shareholders. So, I mean, let's get ready for assumptions here. I do want to say, start off, this PE is 53. So expect not a bloodbath, but I presume it's not going to look as pretty as what some of y'all may think. So the revenue growth side, I think that I could easily see 7% a year. I think, honestly, that's probably too low. 8% a year. What they've done in the past, I think they're way bigger now, but I think they still have that growth. And again, like I said, I think if they were to increase memberships 20%, they'd barely lose any members. And so that's a big portion of their margins. And for margins, they are going up. Maybe I'll be a bit, saying 7 years from now, maybe it's 2.8 and 3% margins. Could be. Who knows? Buy back shares, but they also issue a lot through stock-based compensation. Let's say they just offset that. They offset stock-based compensation using, what are they using? Very inconsequential amount of their free cash flow to do that. But again, you have to balance what you want them to do with what they've done historically. And I don't necessarily want them buying back a lot of shares at this price, probably. I guess we'll see. But for them to just offset stock-based compensation, I'm very comfortable with. PE, I mean, 20. I think you could argue higher. I think this is like a Visa, MasterCard without necessarily the returns on invested capital, but they're not necessarily reinvesting to get those massive rates of return. I think you'd buy this company for a premium because of its consistency. And it absolutely produces immense consistency. I think it has an immense moat. And so for me, let's increase the dividend a little bit. What have they increased in the past? More than the revenue growth. I'll increase it with the revenue growth. Or maybe let's do, just because they have one-offs, increase it like that. But this is saying the company's stock price needs to fall 70% before you get the return I'm looking for here. Again, just looking at that PE, my discount rate's higher than the growth rate. It really doesn't surprise me. This is an absolutely fantastic company. I 100% want to own them. And if I mean, it'd be hard to sell it. But, you know, if I owned it, I'd really want to own it forever. But what's an outrageously expensive price? Is it today? I don't know. But either way, I do hope you enjoy the video and have a fantastic rest of your day. Thank you.